we doing today? Today I want to begin our section on investments. So of course we'll start with investment basics. But first, a quote that's usually attributed to Sir John Templeton's father. The story goes, he told him, "Don't gamble. Buy a good stock. Hold it until it goes up and then sell it. If it doesn't go up, don't buy it." Well, there's as much wisdom as there is humor in that remark. Because success in the stock market's based on the principle of buying low and selling high. Now, granted, you can make it by reversing the order, by selling high and buying low. Not to mention that also those other weird investments, the strange animals, options, and futures. Ugh. But by and large, options and futures are techniques for traders and speculators, not for investors. I want to give you some of the basics for the regular guy on the street, the basic investor who's not going to employ these super complicated strategies, although we'll get into that later on. But today, we're just going to keep it simple. As a professional investment advisor, I've enjoyed a certain degree of success, working in the market for the last 30 years. And I want to share some of the things that I've learned, some of the tried and true things that last over time. So let's start simple. What is investing? Investing is simply a way of growing money. While there are many different classifications of investments, the four major types are stocks, bonds, cash, and real estate. Now, for each of these, we invest our money hoping to get back a positive return, which is just more money than we invested. For the moment, we're going to skip inflation and things like that. So let's just keep that definition to keep it simple. So what is a stock? A stock is an investment in a specific company. It's a portion of the ownership of the company. It's that simple. The stock of a corporation, all of its shares are divided. So a single share of stock represents a fractional ownership of a company. And that's in proportion to the total number of shares they have. Now, it typically entitles the stockholder to a share of the company's earnings. If the company gets sold or liquidated, a portion of the assets after you pay out all the debt and claims. So just very simply, it's a portion of a company. Now let's turn to bonds. What is a bond? A bond is a loan that you make to a company or a government. Sometimes it's known as a fixed income instrument. And the reason for that is because oftentimes bonds, you give them X amount and they'll pay you some amount of interest over time. Now, a bond very simply can be thought of as an IOU between a lender and a borrower, and includes the details of the loan and its payments. Bonds are usually used by companies, municipalities, states, sovereign governments to finance projects, operations, anything they want to get done. And owners of bonds are debt holders or creditors of the issuer. So bond details include the end date when the principal of the loan is to be paid, and the bond owner, which usually includes the terms for the variable, or the fixed interest payments made to the borrower. So you lend them the money, they're going to pay you back either a fixed amount of interest, say 5%, or a variable amount. It changes over time. Now, cash investments normally, when we say that, it includes bank accounts, savings accounts, term deposits, as well as, of course, cash. Now, our last category is real estate. Real estate is most generally thought of to be real property made up of land, the buildings on it, as well as any natural resources of the land, any water, any additional mineral deposits. It can include the air rights above the land and anything under the ground. The term real estate means real or physical property, and real comes from the Latin root res, which means things. The U.S. Constitution initially restricted voting rights only to owners of real estate. So if you didn't own a piece of real estate, you couldn't vote back in the old days. So it demonstrates what an important asset class this is. Okay, what is a stock index? A stock index or stock market index, it's a measurement of a section of the stock market. It's computed from the prices of selected stocks, typically a weighted average, and it's a tool used by investors and financial managers to describe the market, usually to compare it to returns on specific investments. Now, the two biggest and most important stock market indexes are the Dow Jones Industrial Average, which is usually referred to just as the Dow, and the Standard & Poor's 500, which is usually referred to as the S&P 500. The Dow is a price-weighted measure of 30 US blue chip, which means large, reliable companies, and the index covers all industries except for transportation and utilities. They have their own separate index. The S&P 500 is widely regarded as the best single gauge of large US companies. The index includes 500 leading US companies and covers approximately 80% of their available market capitalization. Combined value of these companies is over $9.9 trillion. So you can see how big this gets and how complicated it gets quickly. Inflation. What's inflation? Inflation is just the general increase in prices and the fall of the purchasing power of your money. It's important to understand that because of inflation, a dollar today is worth more than a dollar tomorrow, or a dollar tomorrow is going to be worth less than a dollar today. So now that we have a few basic definitions, I want to talk to you about a few very general basic strategies before we get started. And many of these come from either Sir John Templeton or Warren Buffett. But these are just basic strategies to get you generally slowly into the flow of things. So I want to share with you first 10 basic rules for investment. First, I'll give you the list and then we'll go into details on them. And the first is invest for maximum total return, which means your return after inflation. And I'll say return after inflation, expenses, anything of that nature, taxes. Second rule is invest. Don't trade or speculate. Third rule is remain flexible and open-minded about different types of investments. Fourth is, should be obvious, buy low. Next is when buying stocks, look for bargains, especially among quality stocks. And buy value. Don't buy market trends or economic outlooks. Buy when it's cheap. Diversify. In stocks and bonds, as pretty much anything else, there's safety in numbers. Make sure you always aggressively monitor your investments, but don't panic. Learn from your mistakes, and remember, as Milton Friedman said, there's no such thing as a free lunch. So what do these things mean? First is invest for a maximum total return. And this means the return on invested dollars after taxes, after inflation, and I'll throw in expenses as well. I mean, it's the only rational objective for long-term investors. Any investment strategy that fails to recognize the effect of taxes or inflation or expenses, it doesn't really understand or accurately reflect what your returns are. So it really doesn't make any sense. Now, let me give you a simple example. You buy a house for $1 million, you hold it for 10 years, then you sell it for $1.1 million. Well, looks good. Looks like you made a profit of $100,000. But now if we assume we have to pay $50,000 in taxes on the gain, and maybe we have to pay $75,000 in broker's fees, you didn't make money, you lost money. And that doesn't even take into account inflation, meaning that the gross amount of $1.1 million probably has less purchasing power than the original $1 million that we spent when we bought the house 10 years earlier. So it's important to protect your purchasing power. One of the biggest mistakes people make is putting too much money into fixed income or bonds. And the reason for that is if they're paying you a fixed return, say 5%, but your inflation rate's 3% a year, at the end of 5 years, even with that 5% return, it's probably worth less or only around the same amount as you bought it for. So you always have to watch out for inflation. Let me give you some example. Today's dollar buys only what 35 cents bought in the mid-70s, and what 21 cents bought in the 60s, and what 15 cents bought after World War II. I mean, US prices go up pretty much every year. If inflation averages 3 to 4% and your buying power of a $100,000 portfolio, it's going to reduce it to $68,000 in just 10 years. In other words, to maintain the same buying power, portfolio would have to grow to $147,000, a 47% gain, just to break even over a decade. And that's not even counting taxes. Next, make sure you invest, don't speculate. The stock market's not a casino, but if you get in and out every time the market moves a point or two, or you're continually selling short, you're dealing in options or trading futures, the market turns into your casino. And like most gamblers, you're going to lose eventually or frequently. Now, you may find profits consumed by commissions. You may also find a market you expected to turn down, turning up and up and up in defiance of all your careful calculations and short sales. mean, every time a Wall Street news announcer says, "This just in," your heart will stop. It's amazing how much better the relaxed, long-term owners of stocks do with their portfolios than traders with their constant buying and selling. Relaxed investors usually better informed and more understanding of the essential values, and they're more patient, less emotional. Also, they pay less in capital gains, and they don't necessarily incur any unnecessary brokers' commissions. So, remember to invest, don't trade. Next, remain flexible and open-minded about different types of investments. There are times to buy blue chip cyclical stocks, corporate bonds, treasuries, and so on. And there are times to sit in cash because cash enables you to take advantage of investment opportunities. The fact is, there's no one kind of investment that's always going to perform the best. In particular, industry or maybe a type of security becomes popular with investors, and the popularity will prove temporary when lost and may not have any return for years. Now, having said that, I also want to point out most of the time, clients' money should be in common stocks because nothing outperforms inflation as consistently as stocks do. If you look at history, you'll see why. From January 1946 through June of 1991, the Dow rose by 11.4% average on an annual basis, including reinvestment of dividends. But not counting taxes, compared with the average annual inflation rate of 4.4%, had the Dow merely kept pace with inflation, it would be up around 1,400 instead of 3,000. Now, the figure seems to be extreme to some 10 years ago, but when I calculated a very realistic possibility on the horizon, also look at the S&P. From the start of the 50s through the end of the 80s, 4 decades, S&P rose an average of 12.5% compared to 4% for inflation and 4.8% for treasury bonds, 5.2% for bills, and 5.4% for high-grade corporate bonds. So the fact is that the S&P outperformed inflation, treasury bills, corporate bonds in every decade except for the 70s. And it outperformed treasury bonds, supposedly the safest of all investments, in all 4 decades. So there's no real safety without preserving purchasing power. And just a little aside, I don't like the word stock. I like to use the word ownership in a company. So if you think about it that way, you're buying part of a company. And when you're buying a company, you probably have long-term goals, and you want to think of it that way. You shouldn't be buying a company because you think it's going to do well for 2 weeks or 2 months even. So keep that in mind. If you don't like the company, chances are you shouldn't be buying the stock. All right. Next, goes without saying, almost a cliche, buy low. Of course, it's obvious. And you may say that, but people not almost always, but people usually do the opposite. When prices are high, people like to chase the hot dot, and investors pile in. And when price is down, demand is low. Investors are pulled back, people are discouraged, and they're pessimistic. When almost everyone is pessimistic at the same time, the entire market collapses. And more often, just stocks in that particular field fall. Industries such as automaking, for example, or casualty insurance, they go through regular cycles. Sometimes stocks of companies like the thrift institutions or money center banks fall out of favor all at once. Now, whatever the reason, investors are on the sidelines sitting on their wallets, and they may tell you buy low, sell high, but all too many of them bought high and sold low. Then you ask, when will you buy the stock? The usual answer is, well, after analysts agree on a favorable outlook. Now, this is foolish, but it is human nature. It's extremely difficult to go against the crowd, to buy when everyone else is selling or is sold, or to buy when things look their darkest, to buy when many experts are telling you that stocks in general, a particular industry, a particular company, are risky right now. And Warren Buffett said this best, and we'll mention this in a couple of different places, but be greedy when people are fearful, and be fearful when people are greedy. When it looks like the end of the world, that's usually the time to buy. When everything looks rosy and everybody's piling in, that's usually the time to sell. But in general, if you buy stocks the same time everybody else is buying, you're going to have the same results as everyone else. So by definition, You can't outperform the market if you buy the market. And chances are, if you buy when everyone else is buying, you're only doing so after it's already overpriced. So heed the words of the great stock pioneer, Benjamin Graham. Buy when most people, including experts, are pessimistic, and sell when they're overly optimistic. Bernard Baruch advisor to the presidents was even more succinct. He said, never follow the crowd. I mean, it sounds so simple in concept, but it actually is difficult in execution. Okay, next. When buying stocks, search for bargains, even among quality stocks. Quality is a company strongly entrenched as a sales leader in a growing market. Quality is a company that's a technological leader in a field that depends on technological innovation. Quality is a strong management team with a proven track record. Quality is a well-capitalized company that's among the first into a new market. Quality is a well-known, trusted brand for high-profit consumer products. Now, naturally, you can't consider these attributes of quality in isolation. A company may be the low-cost producer, for example, but it's not a quality stock if the product line is falling out of favor with customers. And likewise, being a technological leader in a technological field means little without adequate capitalization for expansion and marketing. Determining quality in a stock is like reviewing a restaurant. You don't expect it to be 100% perfect, but before it gets 3 or 4 stars, you want it to be superior. Now make sure you buy value, not market trends or economic outlooks. A wise investor knows that the stock market is really a market of stocks. While individual stocks may pull back momentarily because of a strong bear market, ultimately individual stocks determine the market, not vice versa. All too many investors focus on market trends or economic outlooks, but individual stocks can rise in a bear market and fall in a bull market. The stock market and the economy, they don't always keep in lockstep. Bear markets do not always coincide with recessions. An overall decline in corporate earnings does not always cause a simultaneously decline in stock prices. So buy individual stocks. Don't buy the market trend or the economic outlook. Next, like anything else in life, diversify, as there's safety in numbers. This comes to stocks and bonds as well. No matter how careful you are, you can neither get product nor control in the future. You can't predict anything. A hurricane, an earthquake, a strike at a supplier, an unexpected technological advance by a competitor, a government-ordered product recall. Any one of these can cost a company millions of dollars. Then, too, what looked like such a well-managed company may turn out to have serious internal problems that weren't apparent when you bought the stock. So diversify by industry, by risk, by country. For example, if you search worldwide, you're going to find more bargains, possibly even better bargains than in just one single country. Now, always remember to aggressively monitor your investments, but don't panic. Expect and react to change. No bull market is permanent, no bear market is permanent. And there are no stocks that you can buy and forget. The pace of change is too great. Being relaxed, as Hooper advises, doesn't mean being complacent. Now consider, for example, just the 30 issues that comprise the Dow. From 1978 through 1990, 1 in every 3 of these changed. Maybe because the company was in decline, or was acquired, or went private, or even went bankrupt. Look at the 100 largest industrials on Fortune magazine's list. In the 7 years from 1983 to 1990, 30 dropped off the list. They merged maybe with another giant company, or became too small for the top 100, or acquired by a foreign company, went private, went out of business. Remember, no investment is forever. I mean, sometimes you haven't sold when everyone else is buying, and you'll be caught in market crashes like 1987, and there you are facing a 15% loss in a single day, maybe more. Don't rush to sell the next day. The time to sell, obviously, is before the crash, not after. Instead, study your portfolio. If you didn't own these stocks now, would you buy them after the market crash? Chances are you would. So the only reason to sell them now is to buy other more attractive stocks. And if you can't find anything more attractive, hold on to what you have. And don't forget to learn from your mistakes. The only way to avoid mistakes is not to invest, which is the biggest mistake of all. So forgive yourself for all your errors. Don't become discouraged. You certainly don't try to recoup your losses by taking bigger risks or bigger bets. Instead, turn each mistake into a learning experience. Determine exactly what went wrong and how you can avoid the same mistake in the future. The investor says this time it's different, when in fact it's virtually a repeat of an earlier situation, is uttered among the four most costly words in the annals of investing. This time is different. Now, the big difference between those who are successful and those who are not successful is learning from their mistakes. Now, I want to give you one more principle, which is there's no such thing as a free lunch. Milton Friedman said it. Many others have said it. Now, this principle covers an endless list of, admonitions. Never invest on sentiment. The company that gave you your first job or built the first car you ever owned or sponsored a favorite television show of you long ago. I mean, it may be a fine company, but it doesn't mean the stock is a fine investment. Even if the company is truly excellent, the price of its share at that moment may be too high. So never invest in the IPO, the initial public offering, to save the commission. That commission is built into the price of the stock. Reason why most new stocks decline in value after the initial offering. Now, that doesn't mean you should never buy an IPO. You should never invest solely on a tip. Why? Well, it's obvious, you might say. Would you be surprised how many investors, people who are well-educated and successful, they do exactly this? Unfortunately, there's something psychologically compelling about a tip. By its very nature, it suggests inside information or some way to make a fast profit. So, now I want to talk about Warren Buffett. And he says some of the same things, but it's interesting to note. Hopefully you've heard some of these, and we can talk a little bit about them. If you don't know, Warren Buffett's considered probably the single best investor in history. He's called the Oracle of Omaha. And Warren Buffett is a value investor at heart. And that he offers a lot of insight during shareholder meetings and annual newsletters. So it's pretty easy to understand the investing philosophy. And first of all, what does that mean, value investing? Value investing, kind of as we were talking about, means buying low. Buying when companies usually are at a favor, as opposed to growth investing where you're chasing the hot dot. The last few years, growth investing would be, the FANG stocks, which are Facebook, Amazon, Netflix, and Google. These are the high growth stocks. You're buying them at an expensive price, but because they keep growing, people don't mind. But Warren Buffett's the opposite. He's a value investor. He wants to buy things when they're cheap. So over time, he's thrown tons of different tidbits out on investing. Here are a couple of them that endears Warren to all of us. Now, the first is cash is king. Now, why is cash a big deal to Warren? It's important to have a lot on hand at any time because this way you can both withstand big losses and then you can quickly seize acquisition opportunities, when there are real investment opportunities. So sometimes when things go wrong, it's important to have that cash so you can invest it. In a 2011 letter to shareholders, Buffett reprinted a note from his grandfather from 1939. We said, I've known a great many people who at some time or other have suffered in various ways simply because they didn't have enough cash. I hope it never happens to you. Now, this is solid advice for personal finance. You always want to maintain an emergency fund for the unexpected, but you should also keep cash in your brokerage account ready to go. This way you can buy on the dip when things are down. For example, if you had piles of cash waiting to invest when the financial crisis hit, you could have bought low and sold high, reaping huge 50, 100% profits on your investment. However, if you had everything tied up in your investments, you would have suffered large losses like everyone else. Next, we already mentioned, but be fearful when others are greedy. This is one of Warren Buffett's most famous phrases. It's great sentiment, and it's very true of our stock market investing system. Bottom line, avoid the stocks that everyone else is buying, as they're probably overvalued. Instead, look for stocks that few people are buying and paying attention to. Check their fundamentals, and if it makes sense, go for it. Next is dividends are your friend. Buffett loves dividends, as do most value investors. Dividends are a great perk to buying a company, and it usually shows that the company's finances are in good enough shape to support paying out hard-earned money. Now, Buffett likes companies that have a long history of paying dividends and even increasing them over time. A popular tracker of these type of stocks is called dividend aristocrats, which are companies that have increased their dividends over the last 25 years. Plus, Buffett recently announced that they're good because there's a chance that the total amount of dividends paid by his position in Coca-Cola will soon surpass what he paid for the stock. Now, how's that for a great return on investment? Next, always buy undervalued stocks. Once again, Buffett's a big-time value investor. So he's looking to get the deal, which means it's undervalued based on their intrinsic value. Now, he calculates intrinsic value by looking at the company's fundamentals for a minimum of the last 5 years, maybe sometimes longer. And he looks a lot at return on equity, operating margins, and companies that have little or no debt. He compares this company to its peers to see if it's undervalued or overvalued. Now, a key part of this is also looking for companies that have some type of monopoly or special trait that will allow it to be successful in the future. This could be technology, even though Buffett avoids tech stocks and anything he doesn't understand, or he doesn't like the management. But all these factors can contribute to intrinsic value. And last, simple strategy, buy and hold. Buffett's a true buy and hold investor. He holds his positions for long periods of time and constantly reiterates this to his followers. In fact, he said that he likes to buy and hold forever. And oftentimes it's worked out. He's had many positions he's had for over 20 years, which in the investing world is eons. Now, he's also said it doesn't mean buy and hold a company if the fundamentals have changed. He constantly looks at his portfolio, and see for losses. Maybe the company's lost its edge. Maybe they're no longer leaders. They don't have that economic moat around it. So he does sell positions from time to time. Warren, like everyone else, he's a true believer in patience. Basically, don't trade, invest. And we talked about this earlier. Find companies you like. Wait for the right price. It's been said that Buffett has a list of hundreds of companies he wants to invest in. He's just waiting for the right price and opportunity. Now, the last time he went on a buying spree was the Great Recession when stock prices tanked. And he was able to scoop up deals on prices that made him get great returns in the following years. So, follow Warren Buffett. Like I said, the greatest investor of all time. Anyway, I want to stop there. That's our basics of investing. I've given you however many, 20 simple strategies there, 15 strategies. Next time we'll be back with more. We'll get a little more complicated. We'll get past the basics. But anyway, I hope you found that enjoyable. If you have any questions, feel free to email me at joe@platinummethodcoaching.com. Until then, make it a great day.